Hi, I'm Ted Castle. I'm Vice President here at Romano Capital. I'm here today with Kes Romano, our principal. This is a little bit of a strange circumstance. A year ago, we were meeting with you at Royal Oaks in our annual investor meeting, and this year we've had to change our plan a little bit because of obvious reasons with COVID and the difficulty of congregating. But we still feel it's important to bring to you news of 2020 and our plans for 2021, and we want to take an opportunity to do that. Kes, when we look back a year ago where we were, I think we were talking about an upcoming recession. We didn't know what it was going to look like. We had a lot of discussions about inverted bond yields and how investors were making short-term bets over long-term investment, and we were trying to predict what was going to happen. And I don't know if we could have predicted 2020, but it did follow a lot of what we were thinking. So a year ago, we were expecting some sort of recession. We got a little bit different than what we were expecting, but nevertheless, here we are. What are your thoughts on where we're at now?
Well, clearly COVID accelerated what we were predicting, which is a downward turn in the market. We're in a recession. Some of the specific things that were COVID related as it is relevant to our business, we had that 2-month shutdown in construction. And that cascaded into all kinds of problems. One being lack of supply chain was interrupted.
It's important to remember that the development business, it's not just us. We rely on all these other industries. We've got materials and services providers. We have government authorities that give us the permits. All of those things were affected.
Everyone. And so even when they put the green light back on, it took weeks before the governments could get their people back to work.
The permit departments at the county and the city, all of those guys are working from home right now, so these things take longer. Specifically, though, that's had an impact on supply and demand of the things that we're selling in this market.
Right.
Specifically.
Yeah, the net effect, there was both some positives and some negatives. We kind of touched on the negatives being the limited supply. We went from probably 5 months to build a home to 8 months, 9 months, including that shutdown. Yeah. But what also happened is we had a pent-up demand. Here locally, at least, it's very seasonal. I would say 70% of the homes are sold in about a 4-month period of time, which is the spring. That got completely waylaid artificially because of COVID into the summer. And so we had record months in the summer. As a matter of fact, it was the lowest inventory in the history of Clark County since they've been recording it, going back even lower than 2005 before the bubble.
Yeah, to support that, I was just reading in the newspaper that nationwide, we have the lowest supply of homes in the country right now since 1981.
And that's national?
That's national.
Yeah. I mean, that follows what we've been seeing. Sure. We had record sales in July, I mean, just by 3 times.
So how does that impact values then? What have we seen because of that?
Well, clearly that's going to put upward pressure on the pricing. Yeah. So we're going to get more for our homes. So we've been able to sell our homes for 5 to 10% more. But even another thing has happened too, is because of the turmoil in the market, the Fed has continued to keep rates low, and the mortgage companies in turn have lowered their rates, and that provides an opportunity to hold the properties long term. Yeah. So the spread between what you're paying as an interest rate to hold this property and what you're able to get in rent due to the demand for entry-level housing has widened. So that actually adds an entirely different aspect to the building process. Instead of having to build and sell a home, you can build and hold.
So we've got
indefinitely.
We've got higher demand and a shortage of supply.
Right.
And you talked about the seasonality of building in Clark County, and maybe tell us a little bit about what happens if a developer misses a 4-month window. How does that impact the delivery of a finished home?
Oh, that's a great point. Around in the Northwest, the season to build, and by build I mean doing the underground infrastructure of a subdivision, is about a 3-month window, which means you have to the starting date is about a 1-month window. So if you miss the time to start doing the underground, which is the spring, which is when we had the shutdown, if you miss that opportunity, you're not just missing the 2 months, you're missing an entire year. So that entire crop, if you will, of supply is now moved a year into the future, not just 2 or 3 months. So you're dealing with a huge supply hit. So although I think demand has been reduced because people are staying in their homes, it's harder to sell a home, demand is low, but supply has been hit multiple of how much the demand has been hit. So that's what we're seeing.
Right. So who are the winners? Who will be the winners and losers in this scenario?
Well, anyone developing residential and entry-level real estate, and by the way, that means anything from multifamily buildings to entry-level housing.
And when you say multifamily, you mean apartment buildings?
Apartment buildings, right. So really, we think of it like anyone who, your first rental all the way to your first home purchase, that's the space. If we're talking about that space, the winners are obviously anyone who are, any of the developers, builders in that space. However, a major factor is the capitalization of that. So pre-COVID, getting a loan from a bank was significantly easier than it is now. What the banks have done is they've narrowed who they can lend to because they're afraid. They're afraid of uncertainty in the future. However, they still need to make a return, so they are wanting to loan as much or more money because of the low rates. They're making money doing it too, but to fewer borrowers. So it creates kind of a fire hose worth of financing to those who have made it and those who have the capital and resources to be able to. So there's going to be, in essence, a concentration of the developers. So we think that at a certain size, that Romano Capital, with investor funds and the banking relationships we have, we're in a perfect position to take advantage of that.
How does this impact our lending business?
Well, with the lending business, it's probably has the opportunity for the biggest growth and the biggest profit, because a lot of these developers that I just mentioned, we'll call them the have-nots, the ones that have good projects, they've been working on them, but now the banks are no longer lending. What's happening is they have their financing or using a lot of their capital to get the property built, the project completed. But then they don't have the capital necessarily to hold it long term. They need to replenish so that they can go invest in the next project.
Right.
Well, those developers, builders are no longer financeable. So we've seen a huge uptick in loan requests by developers that you wouldn't assume this would happen. And the reason is because the banks are, like I said, narrowing their focus on only the best borrowers. So they're coming to us as a private money lender.
Right.
Whereas, of course, when money is ubiquitous, when it's easy to come by, you're not going to use private money financing because it's a lot more expensive. You're talking about double-digit rates because that private money is funded by investor money that's looking for a return.
Yeah, you and I have talked before about, and we've got this market cycle up here, you and I have talked before about how typically we would think that this is a good place to be, and it is for the property that you own, to have high values and security in that. But we also find that there's razor thin margins there. You have to be very careful about what assets you're purchasing because you're buying them at top dollar. So if we're down here, like you're saying, Kes, it sounds like it opens up all sorts of new opportunities, both in lending and development, and it's all about positioning then. Is that fair?
It is. And the thing that we love about lending is you get in for a lower risk because you're lending a piece of the project. The borrower is putting in part of their capital. And so what's happening is you're getting in for a lower price, but so you'll see right here on the lending, but you're also lending in, and in a lot of cases have an upside equity on that loan, especially in a tumultuous time where the borrower is not able to get long-term financing. So it really creates a huge opportunity, and we've seen, our loan requests go up probably threefold since even last year, which we predicted last year.
Right.
I think this year and even next year, I'll be saying this in 1 year from now, that we'll be even shifting more of our assets and more of our investor assets into the lending side.
Yeah. So let me see if I can recap what you're saying then. We've got some advantages in some specific asset classes, lending specifically, and then residential housing, multifamily housing. What about the other asset classes that have taken a hit from COVID? We've stayed a lot this year away from retail and office. What are your thoughts on how we concentrate the assets we're investing in?
Yeah, well, part of that question goes back to the whole V curve, U curve.
Okay.
Like, we don't really know yet how COVID is going to.
And you're talking about this here, right?
No, I'm sorry. I'm talking about the COVID. A lot of people are talking about the COVID rebound. What's going to happen once the vaccine is distributed everywhere? It's no longer a problem. We're going to get there. We don't know when. Probably later this year. When that happens, the question is, what is the economy globally going to do? I'll answer the more specific question, but the global is that, is the economy going to, a U would be a slow at the bottom and then eventually come back? Or is it going to V, where as soon as is the vaccine's ubiquitous, as soon as we have that, are over that problem, are we going to jump back up? And so kind of the way we look at it is different sectors will be jumping back up and others will die altogether and others will have a long recovery period.
I see.
So within the real estate, now narrowing that down into the real estate space, I think that the multifamily and entry level is going to work not only like a V, but more like a check mark. It's gonna continue to shoot straight up. And there's a few reasons for that. The other sectors like office, I think office will come back. Some people think it's dead forever. I don't believe that. I think it will, but that's going to be a slow recovery.
Right.
That's going to be a U. And then there's other things like traditional anchor retail that may never come back. And for sure, in the same way. So I'd say we're open to any kind of real estate opportunity. But most of that opportunity is in the multifamily and residential space.
And above all, circumspect in all of our decisions at this point.
Yeah.
So let's look at our specific projects. How have they fared in this environment? We did a few big things this year. We got Boulder Ridge off the ground. Westridge was built all year long. Mm-hmm. Let's see, we have the subdivisions up in Ridgefield, the Crossings, and Pioneer Select. We built a new office building this year that we're standing in right now.
Right.
How did these things do this year?
Well, your ping pong game's getting much better. Most of the projects have been, I believe every project you just mentioned is a residential real estate project. Like I said, the focus of the company is going to continue to be multifamily and entry level. I think, the oldest thing you hear about real estate is location. So we've been extremely careful on selecting the different properties that we have and the location. In fact, most of it is either in Camas or in Ridgefield, which are fantastic areas and have a lot of growth. So that's been a focus of ours.
Yeah, and we're carrying all those projects into next year too. Not all of them are done or they're in process.
Right.
And what else do we have on the horizon?
Well, so Westridge, our first multifamily building that we developed ourselves. It will be complete within the next 60 days, likely first quarter of this year. We already broke ground on First Street, which is the 260 some units in near Costco in Camas. We'll be going vertical there in a couple of months. And we just got under contract a couple of weeks ago, yet another multifamily project in Camas. We can't talk about the specific location yet, but we are continuing that trend, looking for the best multifamily projects.
Yeah. What about, we do have one unique offering that we haven't done before, the Qualified Opportunity Zone.
Right. Yeah, so we have our first, we purchased, it was actually at the end of last year, we purchased the first property that would qualify for the Opportunity Zone, which is a really fantastic opportunity. I wish it was bigger and it was a larger offering, because we've had a lot of positive feedback about it, but it's located over by Beaches Restaurant in Vancouver, 18 luxury townhomes, much like our Boulder Ridge project. And only this is going to be a build to hold long term. The Opportunity Zone essentially gives us a zero tax on the proceeds
so any
of a
gain
sale.
Is not subject to income tax liability or capital gains.
Zero tax if we hold it for 10 years. It also has an ability to defer, for people to use deferred funds that they sell from stock proceeds or other home sales to purchase it. So that will be coming probably, I would say, the first quarter of the year.
And this is something that we get this question from investors a lot on tax strategy and investments that they can do with us that benefit them from a tax perspective, which has always been difficult to juggle different 1031 exchanges or changes to the tax code. It is something, though, that we're trying more and more to do, and this is kind of our first attempt at a tax managed fund.
Yeah.
So we talked about what we've got going on in 2021, the projects. I think it's also fair to say that we can expect continued help from the government, given everything that's going on with COVID. I know we just passed another stimulus bill. These things do have positive effects on the economy. They keep money in the system and they provide additional opportunities for investors. Anything else you're thinking about looking forward to 21 and the macro picture of the economy?
Well, I think we've aligned the assets that we're invested in, the projects we're invested in, very well with our strategy.
Yeah.
And I see more of the same coming. I believe that as soon as we get out of the COVID cloud,
right,
we're going to look around at the carnage, and there's going to be a lot of problems going on. And I think that the multifamily will be standing there and be a fantastic investment.
One of our best advantages that we have, relative to other developers in the area, is that it's not just us, that we have you guys also. We're a well-capitalized company because we're doing this together. It's a team effort. We've raised a lot of money, and we can use that money to take advantage of some of these unique opportunities.
Yeah. We are so thankful for your trust in us as managers of a part of your portfolio, and look forward to 2021 and the future beyond that. Thanks for being with us.